What is up, guys, and welcome to episode 6 of the Paper and Purpose podcast. I'm Ryan, and I absolutely hate the feeling of survival mode, the mode where you're living in a primal state of paycheck to paycheck, and I want to help people escape so they can live life to its full potential. This is the podcast where I gather the gems and nuggets about money from the greatest minds I can find to help people escape survival mode. And today's guest exposes esoteric money strategies and tax secrets. I am pleased to welcome Anthony Price. Anthony, welcome on, brother.
Thank you for having me. Definitely looking forward to being here.
Let's get it, man. Yeah, like I was telling you earlier, I came across you on Twitter. You were kind of talking about how the rich use trusts, and I would like for you to dig into that here in just a bit to evade or pay as little taxes as possible. And I thought it was really dope. You share some really good wisdom about taxes, so that's why I'm really excited to have you on. Definitely not what? Definitely not evade?
Definitely not evade. Yeah, they wouldn't do that. They wouldn't do that. The billionaires know that.
I gotta watch my language on that. I don't want to get any of them in trouble.
I certainly wouldn't. Maybe the billionaires. I certainly.
Yeah, you shared something. Right. Yeah, you shared something the other day about how the billionaires will use art. They'll get art appraised, and then they'll jack up the value on it, and then donate it, and then everybody hopped on you. It was pretty hilarious, actually. But yeah, they've got their tricks.
Yeah, absolutely. I appreciate you noticing that it was mostly satire. I mean, you'd be nuts to think it has never been pulled off, but I guess I'll explain the strategy, which is you pay an artist basically $10,000 to create art, which is a capital asset. You can sell it, you can incur capital gains. You pay an appraiser, preferably in your friend group, another $10,000 to appraise it at $10 million. And then you donate it he appraises it at $10 million. And then you donate it to a museum, which is a nonprofit organization where donations to a nonprofit, number one, you won't have to pay capital gains on the asset because you're donating it. And number two, you get a donation if held for long term, which is 1 year and 1 day or more. You get a charitable deduction for the fair market value. So you just paid $20,000 and you just made a $10 million deduction on your taxes, which is worth, $3.7, maybe $5 million of tax savings. Now, it was mostly satire because if you're bribing the appraiser and it's not actually fair market value, obviously that's fraud. Obviously that's a bad tax strategy. The word billionaire in there was really important because only a billionaire or your favorite politician could pull off that strategy. But if you or I tried something like that, we'd get a call from the IRS, and I don't think it would go very well.
Yeah, I think people get really upset when they hear of like Donald Trump not paying a fair share of taxes, or they hear like Grant Cardone paying $0 in taxes or very little amount of money in taxes. When all it really boils down to is people learn how to play the game, the way it's set up, and the way it has incentives for certain parties. For instance, real estate, they benefit people that provide housing. They benefit business owners. Has that kind of been your experience as well?
Absolutely. Of course, the rich who really have a lot of taxes to save, they have greater knowledge and information at their fingertips that they utilize to pay less in taxes on a percentage basis than, a normal middle-class American would. With the last example, while it's kind of exaggerated and I wouldn't recommend that, it's only so many steps off from actually being a viable strategy where, look at Elon Musk. Everybody knows that he donated $6 billion in stocks, or at least it was reported so. But I'm telling everybody right now, go and look up where he donated that $6 billion in stocks. I was looking it up and I struggled to find, maybe they've released something, but I couldn't find where that $6 billion was going. My best guess is that it's going to a donor advised fund or it's going into a private foundation, likely, which he is the director of. So is he losing control over those funds? No, he's not. He's still got that $6 billion of wealth at his fingertips, but is he getting the benefit of the tax deduction? Yes, absolutely. So there's just strategies that we don't get taught about that billionaires, millionaires are implementing in their lives that we don't talk about. We don't get educated on. We don't get educated on basic personal finance, which of course is really important. But once you reach a level of income where you're getting hammered on taxes and your effective tax rate is, 37%, and you live in a state like California where your effective tax rate is 51%, the benefit and the payoff of good tax strategy is massive. And it's really easy to skip over that and not think that's important. But, to think that the reason why the rich aren't, getting taxed enough is because the rates aren't high enough, that's just crazy. I mean, there's just so many loopholes and ways around it that the rich just know about, that they're implementing, that, that's really the problem is how complex it is. And that's what's not fair about the system. It's the lack of information.
Right. So I once heard an accountant say that the CPA exam really doesn't teach you how to save money on taxes. It teaches you it teaches you how to be compliant with IRS laws. You really have to go and do your own kind of deeper research to really find the loopholes. Has that been your experience as well?
It barely even teaches you about taxes. I mean, of course, you have to exercise a level of expertise in taxes. Yes, and that's kind of an exaggeration. I can already see the CPAs in my mentions that are mad at me. But think about it. There's 4 CPA exams. There's business environment and concepts. There's financial accounting and reporting. There's audit, and then there's regulation. Which one of those is taxation? There's only taxation on one of them. That's regulation. On regulation, you're also looking at bankruptcies. You're also looking at other laws and tax preparation laws. You're not even looking at tax laws for individuals and for businesses. I mean, that's a quarter of one of the 4 tests. So taxation on the CPA exam is 1/16 of the knowledge that you have to have, essentially. You don't have to have a crazy extensive knowledge in taxes in order to, pass the CPA exam and be a tax expert. And CPAs definitely are more credible and have more tax information than your average, person or bear out there. But in terms of tax strategies, I mean, as much as I sound like a conspiracy theorist to say that they're a lot more held, close to the chest at the higher levels of income and assets, it's just true, and they implement them. And they have money to throw on them because they get massive returns on that. And they get significant benefit from, people not knowing them and paying more in taxes because they got friends. I mean, the billionaires, they got friends that are politicians.
So I know you've had some content on crypto. Do you think there's going to be any kind of like easier tax system with the blockchain and with the idea of everything being like transparent and open and despite how much more control the government would kind of have over a situation like that? Do you think that would ever make the yearly tax situation easier on the personal level and at the business level?
Man, I want to say I hope so, but at the same time, that's definitely a big issue. I mean, when it comes to crypto technology, the blockchain technology specifically, obviously regulation is really important. It's a really big issue, and how do we go about that in the first place? Here's another issue that I see with the blockchain technology is even specifically Bitcoin is the blockchain is public. And as great as that is we all do have a right to privacy. And as much as, you shouldn't have anything to hide and, you should just be transparent with everything at the same time, I kind of want to keep some of my transactions private. Like when countries or when companies are looking to make moves or make decisions, if their competitors are able to see all of their transactions real time, think about what that's going to do for the competitive business landscape or just general privacy. We do have a right to privacy, and if we don't build out the blockchain infrastructure with some inherent privacy, it doesn't have to be every single blockchain that's ever used, but I see that as really important as we build out that blockchain infrastructure. And obviously that's going to be a challenge. I'm looking at those coins like Zcash and what kind of infrastructure, what kind of smart contracts we can build out. Privacy is going to be a big issue when it comes to regulation. The taxation of it, the IRS, they can't just fit this square peg into the round hole because this is a whole new type of income. Is a DAO a security? Is it not a security? Well, it's a DAO. It's a completely different thing. We need to look at this independently of the regulation and the structure that we've had in the past and give it specific rules because it's going to hurt innovation if we try to fit old, obsolete rules to this new technology or new structure or way of producing income or of raising funds together. So there's so many different unique transactions, ways to make income, ways to pool funds together, that I understand why it's taking so long for them to regulate, because this is definitely a big issue. But at the same time, seems like Europe with their regulations is kind of leading the way in terms of trying to roll something out. So I wish I had more clarity as to the direction that they were going to go. For now, it seems like they're trying to fit, crypto into, their old obsolete rules, which, we can certainly talk about. But at the same time, they pretty much got to get something new out there to clear the way for innovation and growth in this industry, because it's really going to disrupt, massive technology. It is a technology that's going to disrupt all kinds of financial and economic processes in all industries, in all sectors. I mean, contracts and transactions are in every single industry and in every sector. So it's right to change all of that.
So tell me, what a nightmare has it been? I know it has been just at the personal level. What's it been like being a CPA, having to record people's crypto transactions, their NFTs, their capital gains on CumRocket or whatever they're investing into? What's that been like?
Yeah, a lot of money was made there. A lot of gains from the CumRocket. It can be a big mess. It can be a really big mess. Now, it's important. I want everybody to know this. Before you go and be a degen, as fun as it is, as much money as there is to make, you could be having nightmares this coming tax season if you don't plan for your transactions and tracking your taxable, trades. Because a lot of people don't realize, even just trading, Bitcoin for Ethereum or Ethereum for an NFT or Ethereum for CumRocket, you're creating a taxable transaction that you have to track. So it's good throughout the year, number one, to know what transactions are going to be taxable, and number two, to put those transactions into a crypto tax software so you know where you're at. Because at the end of the year, if you don't know where you're at, you don't know if you need to cut some losses so you can reduce your gains at the end of the year. If there's any tax planning opportunities, if you have massive gains, what are your options for putting it into a, trust, or putting it into implementing some kind of tax saving strategy, because it can get really messy. I mean, people come to me, in April and they go, man, I've traded on, XDC blockchain, I've traded on this blockchain, and they've gone deep into the DeFi, not just Ethereum and Binance Smart Chain, but they've gone deep into blockchains where there's not even downloadable reports. I mean, what do we do when there's no downloadable reports? How do we even scrape the data together to try and track everything that goes from blockchain to blockchain to blockchain? And you have to track every time you convert one crypto to another. Not only is there a sale, which there's gains to calculate on, but there's a subsequent purchase, which creates the cost basis that you now need to track with those units going forward. So, the crypto tax softwares definitely help a lot, but we still run into those problems when we have those, deep degens that are trading on the XDC network or the Harmony One network, because the integrations right now with the crypto tax softwares are not advanced enough to handle some of those blockchains. If you're just a simple crypto trader on Coinbase, in MetaMask, Ethereum, that's pretty simple. There won't be all that many issues, unless you miss one of the wallets that you forgot you traded on. You didn't know all the wallets and the exchanges and the blockchains that you traded on. But if it's simple, usually not too bad. But if you've been doing thousands of trades throughout the year and you've been just going as deep as you possibly can, doing all kinds of bridges and LPs and stuff like that, it can become a nightmare, man. It can take me, double digit hours, almost triple digit hours, literally, for the biggest of nightmares. And so people need to be ready for that. I mean, seriously.
So you briefly mentioned something that originally put me onto your content.
Prep. Mm-hmm. Sorry to cut you off. There's a little bit of a delay. The last thing I wanted to say is just
go ahead.
With crypto tax prep, some people might have a really simple situation. They just got a W-2, but they got such complex crypto tax situations that they're going to have to pay more just to compile their crypto tax, bookkeeping and their capital gain transaction reports, then they'll have to pay for their entire, tax return. So if you want to be a degen, you got to realize that this is going to come at a cost.
Yeah, you mentioned something that originally put me onto your content, and that's trusts. You've had a couple of threads and a couple of reels that you've made about trusts and how they're one of like the best tax safe havens out there. Could you just educate my audience a little bit on trusts and why they're one of the best ways to preserve your money?
Absolutely. I would say this is one of the biggest products, services, or more specifically pieces of knowledge that do not get taught to, normal, low, middle class, even upper middle class families, the importance of a trust. I mean, there's over 80 different types of trusts, and someone that thinks they know what a trust is, you then talk to them about a more advanced type trust, and they try to fit it into this one type of trust, and they have no idea. They can't compute it in their mind. I mean, there's just so many misconceptions and misunderstandings of how a trust works. So basically, a trust is a contract, and it has to have at least three parties. So there's going to be an initial grantor or settlor or trustor, where they do the initial granting of the trust and settlement of the trust, because the contract has to have some type of consideration. It could be dollars, it could be assets, whatever thing with value, you have to do the initial granting into the trust to create the contract. Then you have the trustee. The trustee is responsible for executing the contract. That could be investing a certain way, or they could have the discretion to invest how they want. Depends on the provisions within the trust. The trustee buys, sells, it invests, it expenses, or it distributes to the beneficiaries. So the third party is the beneficiary. The beneficiary gets to benefit from the trust. And so there's many, many different variations from there of types of trusts and how it's going to benefit the grantor or the trustor, the grantor, the trustee, or the beneficiary. It goes really deep, man. It goes really deep. There's trusts specifically for protecting your assets, domestic asset protection trust. I mean, there's trusts that are to mitigate capital gains, like a charitable remainder trust is really effective at that in serving a charity. I mean, there's trusts for trying to basically go dark and making your assets completely private. And it just goes deeper and deeper from there.
At what point do you think people should consider or start doing some research into trusts? Is there a certain like number or like amount of assets that somebody should start considering something like that?
I'm going to start by saying this. Honestly, trusts are all about contract law. Mm-hmm. Trusts can also be a lot about common law. These types of laws affect us whether or not we have a trust. And so to me, it's important to try to understand what actually is the law of the land. When's the last time you actually went and tried to understand the Constitution? When's the last time you looked into the Internal Revenue Code? When did you look into the 14th Amendment, the 16th Amendment? What does that stuff actually mean? What does a U.S. code actually mean? I'm not going to get too much deeper into that because everyone's got their own interpretation of that. And there's a lot of case law around what those things mean. But everyone should have an understanding of the law of the land. And most people don't realize how much contract law and common law come into their everyday lives, right? We've just been indoctrinated into it, and it just is what it is, where we have certain rights available to us that we just don't really know about, right? And so that leads me into kind of talking about the trusts, where anybody really that has any assets or income should be looking into a revocable living trust, or really like anyone that wants to avoid probate, anyone that wants to leave some type of legacy or assets and not have your family go through this arduous, long, expensive, stressful probate process should be looking into a revocable living trust. So if you make, over $50,000 a year, if you have over $50,000 of assets, likely you want to put together a revocable living trust. So if you pass away unexpectedly or expectedly, you have a will, you have a contractual agreement of how your assets and your income after you pass away is being distributed per the way you say you want to contractually. Otherwise, it's the government's contract, and the government gets to distribute based on their rules, based on how they see fit. So that's where I would start. From there, it depends on your financial situation. If you're if you have a bunch of real estate, you probably want to look into asset protection. And as great as LLCs are, you'll find that when you have single member LLCs, they're considered what's called a closely held corporation. If you have a single member LLC, maybe just a couple partners within that LLC. So when they really take a look at what's going on in the LLC, they'll evaluate for what's called alter ego. And if you're just acting as the puppet master for this LLC just to benefit yourself, oftentimes they're able to pierce the corporate veil. And therefore that LLC that the attorney sold you on asset protection is actually providing zero asset protection whatsoever, just for alter ego. Now, it could also be pierced in the case of commingling personal and business funds, which of course I see quite a bit with throughout my career, or undercapitalization of the business, or not keeping proper annual records. I mean, all of those could lead to, your assets being taken out of your LLC, or you being personally liable for liabilities of the business LLC. So LLCs, as great as they are, they're better than nothing holding it in your individual name. They don't provide the same level of asset protection that a trust would, whether that's a domestic asset protection trust like a Nevada asset protection trust, or whether that's some kind of a irrevocable non-grantor, not self-settled type trust that really separates the legal ownership of your assets. Instead of you owning the assets, the trust owns the assets, where you get to control it, but you don't own it legally.
Yeah, I think one of the most recent examples I remember of that kind of getting exploited was Chadwick Boseman, or Bosman, however you say his last name, actor from Black Panther in 42. I can't remember what his estate that he left was, but
Yeah.
I don't remember how much of it got eaten up by a death tax, or how much of it was just because he didn't have anything kind of set up like that. And he was a very young guy. So, I mean, when people hear trust, it might be something they think of like when they're 50 plus and they're kind of getting on in age, but it's probably one of those things that people should probably start considering much younger than they really are.
Yeah. Yeah. I mean, I completely agree. And Michael Jackson as well was another, very famous, very wealthy person that passed away and didn't have any type of estate plan, will, trust, anything like that. And I mean, think about it. The current estate tax exclusion limit is $11.7 million per spouse. So if you're married, it's up to $23.4 million. Anything above that, the estate tax rate is extremely high. I mean, it very quickly gets to, I want to say 50%. Don't quote me, it's somewhere around 50%, and it could get higher. So if you have a $200 million estate with someone like Michael Jackson, the government's going to come in and take $100 million of that easily.
So, I know you kind of specialize in real estate and entrepreneurs and people kind of in that segment. Do you have any kind of practical tax advice or some advice for people to kind of optimize their taxes for just a regular W-2 employee, aside from going and getting into real estate or starting a business?
Man, those are my favorite ones. Yeah, I mean, there's a couple of them that we can talk about. Of course, you said I can't talk about real estate, so I guess I'll avoid talking about how that's really the best tax saving strategy for people in the middle class and people that make W-2 because of that depreciation. But we'll talk about something like a charitable remainder trust or a private family foundation, which is another charitable trust. I mentioned it earlier when I was giving that Elon Musk example. It's not only for the billionaires. I would only recommend it to somebody that's going to, make more than they spend on the private family foundation, and it's actually worth their money. So it's probably not for somebody making, $30,000 a year. But if you're in that, $200,000 or more of W-2 income, being able to contribute 30% of your AGI to a private family foundation, where you can shave that $200,000 off, or 30% of your AGI. Like, let's use the example of someone that makes $500,000 of W-2 income. you can contribute $150,000. That's 30% of your AGI. So you're contributing $150,000 to this private family foundation. So first, let's just calculate the total taxes saved. If your marginal tax rate is, 35% on a $150,000 deduction, I mean, you're saving $52,000 and $52,500 in taxes, right? At a 35% marginal rate, which it could be even higher than that at $500,000 of W-2. So what are the regulations? What can you use the money for within a private family foundation? Well, fortunately, you're the director of that foundation. So the main regulation around the use of the funds is that you have to distribute at least 5% of the net asset value on your charitable purpose every single year. So now you've got $52,500 in this, $150,000 in this private family foundation. You have to distribute at least $7,500 out of it. So what can you use the $7,500 out of it? Well, you can just give it directly to another charity. You just flow it right through to another charity. You just netted $45,000. You can invest the rest, right? Put it all into stocks, put it into crypto, buy real estate with it, whatever you want. That's an easy one. You can fund your own trips you can fund your own charitable missions. You can throw an event for charity where you're fundraising from other people. For the business owners that want to, leverage the rules of 501c3 charitable organizations, you can, dig deep into the rule books and figure out how you can create a positive feedback loop of a nonprofit with a for-profit. And you can do joint ventures where you're driving dollars into your for-profit, which of course is making profit that you're going to personally benefit from. But you're also sending that 30% AGI of profit, you're sending it over to the private family foundation. And you're doing this joint venture because ultimately, your nonprofit is benefiting from the business activity together, right? And here's one of my main additional pieces of information that I absolutely love. 501c3 organizations, oftentimes, and for the main tech giants and social media platforms, that's Facebook, Google, Instagram, and YouTube, you can qualify for up to $10,000 a month in free ad grants. So if you're an entrepreneur and you have a business and you want a joint venture with your nonprofit business, you can advertise for your for-profit, nonprofit joint venture. You're advertising them both together and you're using OPM, other people's money, and not just other people's money, it's the big tech platforms' money to then advertise on their platforms, which is driving dollars to your for-profit, which is helping you save taxes by then putting that money into your nonprofit. And it's a positive feedback loop. It grows your wealth, it helps you save taxes, and it benefits a charitable purpose better than your taxes do. And a lot of people, honestly, they don't love sometimes when I point this out, how you can leverage these rules. But you'd be crazy to think that billionaires and these massively wealthy and elite people are not doing this. This is why they set up the rules like this, so that they could know them, so that they could leverage them, so that they could benefit. And so you could think that it's like immoral to leverage the rules for your benefit, even though, you're ignoring the fact that it's also benefiting the charitable purpose. But that's just honestly a scarcity mindset, because if you become more wealthy and you're a good person, you become more of who you are when you're rich. And so if you become more of a good person, that's just benefiting the world. So, obviously use this wealthy, rich tax strategy information to make the world a better place. But that's one of the most powerful tax strategies and really wealth strategies that I've ever uncovered in my life.
I've never heard a lot of that stuff before, so that's good to hear. So you're somebody who is kind of leveraging the internet to build your own business. I'm doing the same. I think the creator economy is something that is really just getting started, even though we've kind of been tapping into this for a while. Talk to creators about maybe some ways they should think about structuring themselves tax-wise, or some different benefits they can have as far as writing off different business expenditures. How can creators save the most money on taxes?
Yeah, that's absolutely one of my favorite industries and types of people to work with, because they're creative and they're fun. And My one complaint is that sometimes they're not as organized as they could be because they're too busy thinking on the big picture. But content creator is really cool because this is not a position or a job or a business that's been around for a really long time. But think about it. You're a content creator. I've used in one of my reels before, I mentioned the Nelk Boys and how everywhere they go, they're constantly traveling. They're constantly shooting content. So everywhere they go is a business trip. Everywhere they go is a write-off. Oh, I got to take the private jet to go to Brazil so that we can shoot content and riding four-wheelers in the favelas. It's like, oh, that's a write-off. So when you're a content creator, you got to be shooting content. And if you go places and you have the business purpose of, oh, I need to go to New York and I need to go be, shooting content on the Brooklyn Bridge. And I just so happen to stop into a bar and have a good time, for an hour or two, then you get some personal enjoyment too. So when I talk to content creators who are looking to save taxes, that's the lifestyle that I want to live too. Because my favorite part about tax planning is getting the most personal enjoyment out of being an entrepreneur. That's why we are entrepreneurs. It's for freedom. It's so that we can enjoy our lives. We chose this lifestyle. We chose the extra stress and the extra hours of being an entrepreneur so that we can enjoy it and enjoy that freedom and enjoy that lifestyle. So part of that is going out and traveling. Part of that is doing business, wherever you want, whenever you want, with who you want. And if you do it right, you can write a lot of that stuff off. So I've been doing a lot of traveling myself. I've been going to, conferences in Dallas. I've been going to conferences in Vegas, meeting with some clients and some associates in, the Tahoe area. And when I have a business purpose for every single weekday, I'm able to write off that travel, including my meals, right? And even on the weekends, Saturdays and Sundays, as long as you have a sandwich of business purposes on that Friday and on that Monday, IRS recognizes that you don't have to work on that Saturday and Sunday. And so you can still write off the trip and your meals and your travel if you have to be there on the weekend, even if you're chilling, by the pool, at one of the day clubs in Vegas, right? So you got to know these rules to save more money so you can go spend a little bit more when you're having fun, with this entrepreneurial, freedoms and travel that you're able to do. So content creators have just an amazing opportunity to do just that because you can make a lot of money and you can travel and go anywhere you want. You just got to be smart about taxes.
Content creators, y'all hit up Anthony Price if y'all are trying to save some money on taxes. So recently you tweeted you need to get so rich that your net worth becomes zero. Can you elaborate on that? I think I know what you meant by that, but elaborate on that for my audience.
Absolutely. And I'm even going to reference someone that everybody these days knows is Andrew Tate, who always talks about, having the corporations and the trusts. And everybody's seen these viral videos of people talking about, I've got a corporation that owns my trust, that owns my corporation, that owns my trust, that owns, 3 LLCs. It's like, some of that is doing too much. And I will admit that, there's a lot of misinformation out there and people that are, walking their clients right into sham transactions or, BS that can get them in trouble. Try not to get it too complex. But owning things in your personal name is essentially the highest legal risk you can possibly have. Having at least an LLC, that's the next step. That's a baby step. All right, I have an LLC. I have somewhat liability protection, somewhat. It's kind of just a level of mental comfort because if really put under the microscope, if we go to, court and you accidentally forgot to file one piece of paper, you're done. There's no asset protection. But then you get into trusts and you're absolutely nuts if you think at the highest level, they are not putting the majority of their assets into trusts and they're putting them into private contracts where we have the inherent right to privacy. We have the inherent right to creating contracts. And so people do so and they take their assets out of their name and they put them into these trusts. And so now I'm going to venture into a little bit of speculation, but I'm going to suggest, and I'm going to suggest that likely the richest people in the world are not the richest people in the world on paper. I mean, Elon Musk, for sure, he's definitely one of the richest people in the world. But do you think those guys out in, Saudi Arabia that are sitting on these massive oil deposits and these massive reserves, they're calculating every single little dollar they have, and they say, hey, Forbes, this is how rich I am. Check that out. No. Number one, it's really hard to calculate that stuff. Your actual net worth based on the value of commodities changing every single day, or the value of your companies, because you have to find a buyer. There's not really a fair market for a $1 trillion company, right? Unless it's publicly traded, which is why all the richest people in the world own publicly traded companies. What about the private companies, right? We don't really include a whole lot of those on the richest people in the world. So their net worths really are zero because they don't own anything in their name, right? They have corporations that own their business vehicles, or they have trusts that own their personal residences. If they were to get sued individually, they wouldn't be all that concerned because there's nothing to take from them. You'd have to find a way to sue the trust. You'd have to find a way to sue the corporation. Oh, you get that corporation, you want to, put a judgment on them for $10 million, but you can only do it on this one corporation that wronged you. So you can only take $100,000 worth of assets. You can't get anything else. Sorry, they don't own anything else. But he has access, he has control over hundreds of millions of dollars in these other entities. So, how that looks for everybody is obviously different. But trusts, corporations are absolutely the vehicles that the wealthy are using to control their assets, but own none of those assets. So when I say you need to get so rich that your net worth is zero, it means you need to have enough money to be able to have the assets you don't want to lose and pay for the greatest advisors and greatest entity structures that are going to take your assets off of the map of availability. Or, a lot of the real estate is public information. So I can look up, Donald Trump on a public register in New York. Am I going to find all of his assets? Hell no, absolutely not. Because his assets are in private trusts, and his assets are in trusts that are not named Donald Trump Trust. They're in trusts that you have no idea are connected to him. So the fact that we have real estate and we have other assets that are literally public information means you really need to have trusts that are going to make your assets private, because without that, once you get a good amount of assets, you become a target. And if you do somebody wrong, you get into business and you have any frivolous reason even to get sued, a person with a lot of money and really good lawyers could take advantage of that, and you're screwed. So
a little bit of a selfish question. I wanted to ask, I just got married a little over a year ago, and the best tax advantage I've really made out of that situation, not that I'm really just trying to exploit my marriage or anything, but hey, if you're getting married, you might as well make the most of it, is long-term capital gains tax. It doubled what I was able to claim on long-term capital gains. So that's been the best tax advantage I've had being married. Are there any other tax advantages for married couples?
That's definitely a big one. It takes your, the long-term capital gains rates. I want to say it's, when you're single, $0 to $40,000 of taxable income, you're taxed at 0%. So now when you become married, this is a really big one for older couples that have taxable brokerage accounts. The first $82,000 of income, if it's from capital gains, long-term capital gains, it's taxed at 0% income. And then married, the next $400,000 of long-term capital gains is taxed at 15%. So that's a really big one. When you're married, one of the best strategies being married is, again, getting into rental real estate, because while one of the spouses may be working and super busy and have this, high level W-2, the other spouse may be, staying at home with the kids and therefore have more time available to go out and qualify under the material participation rules for real estate and therefore be classified as a real estate professional. And when you classify as a real estate professional, while you may have a rental property, if it has losses due to that depreciation, you can take up to $25,000 of those losses and have it offset your W-2 income. So that's why, having that real estate pro status, having real estate in general, is going to be one of the best strategies for offsetting income, for offsetting, W-2 income, if you can qualify as a real estate pro. That's a big one. I mean, having kids, once you start to have kids, obviously just a tax credit right there, child tax credit, $3,600 a year for kids under 6 years old. But once they get a little bit over 6 years old, and you can have them do some activities in your businesses, hiring your kids is one of the greatest tax strategies available, right? So if you have your kid sweeping floors, doing however many hours of work in your business, obviously you have to actually compensate them for services. It shouldn't just be frivolous payments. If they do a little bit of work that you can compensate them for, you pay them a reasonable wage, 15, 20 bucks an hour, whatever it is. And if they're under 18 and you do it out of a sole prop or LLC, you can avoid having to actually file a W-2 because they're under 18. They're probably not going to sue you for unemployment. They're probably not going to sue you for workers' compensation. And that's the justification for not having to file a W-2 in your kid's name. So if you hire your kids and pay them on a W-2 that you don't have to spend the money to file, they're not paying any taxes on that income because it's under the standard deduction of $12,700 for 2021. Maybe it's $12,950 for 2022. You can take $6,000 of earned income and contribute that into a Roth IRA for the kid because he now has earned income too. So you have a business deduction, right? And they have income that they don't have to pay taxes on. And now they just put it into a retirement account that 60 years from now or 55 years from now, when they're going to distribute, they're taking it out tax-free. So that right there is one of the trifectas and the best tax strategies that I love to implement for my clients. And when you get married, when you start having kids, you got to be looking to do something like that. When it comes to other strategies being married, there's not any massive differences. Most of the time, it's just going to broaden the tax brackets. So if, you are making more money and your wife's not making as much money, it's going to help reduce the total tax paid on the income that you make, or vice versa. We're equal over here.
What about for my investors? So this page kind of started a lot more trading and investing focused. Aside from long-term capital gains tax and you giving the advice to not have 3,000 crypto transactions in a year, is there anything else investors should be thinking about tax-wise?
Yeah, I mean, when it comes to trading, options, stocks, that kind of stuff, a lot of people ask me if they can write off their monitors or if they can write off a lot of these expenses related to being a trader. And honestly, usually it's not worth the effort and not worth the requirements, and they just don't fit in the requirements. So I'll talk about day trading rules quickly. The IRS has a classification for self-employed investors that depend on day trading income. So they're going to look at a couple different things before they allow you to take your trading income as self-employment income and therefore deduct expenses on your trading income. They're going to look at things like the amount of trades that you make, either daily or weekly. If you're doing 5 trades a day or 15 trades a week, then you could be a day trader. They want a minimum of $25,000 account balance throughout the entire year. You got to have a bag that you're using to, get in and out of these trades consistently. What other work or income are you making? Are you depending solely on this trading income? From there, it's, how much money are you making? Are you making enough to consider yourself as, fully self-employed? And based on the story that you can put together, based on those considerations, potentially you could classify yourself as a self-employed day trader. Honestly, the majority of people that ask me that question are not going to qualify. So if you do, there's certainly some tax strategies there where you can write off the coaching and the consulting. You can write off the monitors that you buy. You can write off the home office deduction. It's a self-employed, it's a business. So you can write off all the normal business deductions. If you're an investor, you're a trader, to me, it's most important to be aware of the wash sale rules. It's most important to be aware of your gains and losses throughout the year. So before the end of the year, if you need to be cutting some of those losses, tax loss harvesting. It's going to be the most effective tax saving strategy because, if I bring up a qualified opportunity zone or charitable remainder trust, sometimes people are interested, but if you're making your money from stocks or you're making your money from trading crypto, oftentimes you don't want to go invest all your money long-term into some real estate. So the bigger capital gain saving strategies are just not of interest to a lot of, normal crypto or stock traders. So tax loss harvesting and crypto wash sales are easily the most important tax saving strategies that everyone should be aware of.
Anthony, I feel like I've asked most of the questions I think will benefit my audience. I usually kind of wrap these things up by just asking a couple of rapid fire questions about just life and just kind of your perspective on things. I feel like I've got a free consultation hour from you, so I really appreciate that. Thanks for not billing me. That's kind of why I do this podcast. I just get some free info from people. But I'm just going to hit you with it.
Of course. Please do.
So first off, what would you title the chapter of life that you're in right now?
I would say builder mode. Right now I'm going through some growing pains, honestly, because I'm building the firm a lot. I feel like I was gaining information in the last chapter. I was gaining skills in the last chapter, and now is time to really grow and really affect a whole lot of people. So right now, just building the business. Really trying to scale effectively, and now people are going to be relying on me for their paycheck, and now we're going to start seeing some real serious returns. So just in a serious period of growth where all my energy, all my attention is being focused on the business, and it's stressful. It's definitely overwhelming, but it's so rewarding and definitely the best season of my life so far.
I feel that 100%, man. What is one of the best or most worthwhile investments you've made? It could be an investment of money, time, or energy.
Easily in myself. Easily all the investments that I've made in myself. Again, I'm gonna talk from the business owner's perspective. The investments I've made in coaches, the investments I've made in growing my skills, and the investments I've made in people then wanting to see me win. Right? It is insanely beneficial to invest in a community where now everybody is excited that you are a part of that same community. They want to give you value, they want to share value, and they want to see you win. So communities, crypto groups, crypto communities, masterminds, social media coaches, and people that want to see me win and grow on social media. Mentors in my industry. I paid other CPAs just to help me know what to do and answer my questions and always be there and be a part of my community. This is a really hard thing for solo entrepreneurs to figure out is, you feel like you're on this road all by yourself, where if you invest in coaches, in a community, in people that really want to see you win, you're not doing it alone anymore. Right? You still have, 100% of the equity, but you have people that are invested in now your success. And so the investments I've made in coaches, in programs, in skills, ultimately in myself, have more than any other investment, even my crypto from 2018 has paid off way more than anything else I've done.
I love it, man. What are some bad recommendations you hear in your profession or area of expertise?
Well, there's quite a few, honestly, and it's really specific to everybody. I hear a lot of people say, don't even look into the employee retention credit, where if you qualify for the employee retention credit, it's literally free money. So if you're getting calls from those guys that say you qualify, at least figure out if you do. Ask your payroll provider, ask your accountant, or even do your own research to figure whether you do qualify. And this is for the employers out there, because this is literally free money. If you, again, I'll emphasize, if you qualify, free money. Other deductions that say, it doesn't work for you. The 280A Augusta rule deduction. You can't rent out your home to yourself. Well, what if you have a business purpose? What if you do it at fair market value? What if you document properly? What if you do it under 14 days? Well, that's all the qualifications you have to have in order to take the deduction. Yes, you can take it. Being overly conservative is a bad recommendation. Being overly aggressive is a bad recommendation. You want to find the deductions that might not fit some people, but they fit you. You want to avoid the deductions that other people are taking, but if they don't fit you, it's done for you. You really, need to know the rules yourself and how they fit for yourself, where you need to have an advisor that knows who you are, you have an intimate relationship with, so that they can give you very specific recommendations, because having a bad relationship or having not a close relationship is just going to ultimately lead to plenty of bad recommendations for an individual's tax situation.
One last one. This is one I really like to ask because I think it impacts my viewers a lot. What advice would you give to a smart driven college student about to enter the real world, or what advice should they ignore?
I mean, to an extent, like here's some advice that you may want to ignore, and that's like, I don't. This is gonna sound bad, but like, because I can't think of a better way to say it. Like, follow your dreams. Obviously, you should follow your dreams, but to think you're gonna enjoy every single second of the path that you're on has not been my experience. Right? Not everybody loves being a public accountant and being a CPA, but the 2 years that I spent grinding 70 hours a week in public accounting led me to now find a purpose in helping people save taxes, helping educate people on how they can save money on taxes. It's helped me create a mission and a purpose and make it extremely profitable for myself. But I had to sacrifice, I had to accept the fact that I wasn't going to absolutely love every single second of my day. There is a level of sacrifice and struggle that you have to face in your life to grow the calluses, to grow the skills to where you're going to go. So advice that you should ignore is, not follow your dreams, but that, you should love every second of the work that you want to do. Ultimately, you want to enjoy, the majority of it, and you want it to fulfill you, more importantly, and give you meaning and purpose. That's really what I would focus on when someone says advice like that. And the other thing I want to say, I kind of lost my train of thought, so I have to bring it up. Here's what it is. Focus on building a skill. We talked about the creator economy and the digital economy, and that's not going away. If you have a skill, if you can cultivate a skill and you can find people online, and now that we have, the digital economy, we have the digital space where everyone's on it, you can find people that have the need of your skill. If you can just put yourself out there, you will be so ridiculously successful. A lot of the most successful people right now are, building skills and marketing them online. So in college, for those, very, hardworking college students, figure out what skill, what value you can obtain from your college degree. I was just going to go do finance originally. And by the time I graduated, I go, I guess I could just get into, financial planning or advising, where a lot of those positions are sales, right? So what's the skill? It's sales. Then I got into accounting, where what's the skill? It's either auditing or it's doing taxes. So my skill is having extensive tax knowledge, on the hardest, piece of literature to read, knowing that in and out. No one wants to read the tax code. So if you actually read the tax code, know it intimately, and know how to implement that for your clients, that's an extremely valuable skill. And there's not a lot of people my age that are doing stuff like this. There's a few, they're killers. They're awesome. They're going to make so much money in their lives, as I plan to as well. But I had to gain that skill. And that goes into the first part of my whole rant here I got going on, that it kind of sucks. And you're not going to always have immediate success. It took me 2 years to be able to go entrepreneurial with my skills. And that was super early for me to go and do that. Now on the digital economy, some people are doing it after 6 months, but realistically for certain skills, you might have to grind for years. And in the world where, everyone's just used to instant gratification and wants it to win, the next day, because you've seen some people on Instagram, pull it off. The reality for the majority of people is success is an extremely slow process that can take a decade, 2 decades to get to where you want to go. You have to be willing to do that, and you have to enjoy that process too. Otherwise, you're going to look back when you're 50 and you're rich, and you're going to go, all right, I'm rich. I just hated the last 30 years of my life. What was that all for? So that's what I would say is build the skill. You're going to have to grind, but find the purpose in those struggles and sacrifices.
I don't know a better way to end it than right there, man. Those are some good words. I wouldn't say that was a rant at all. I think you said some stuff that some people need to hear, and that was great, man. Thank you so much for your time, Anthony. This has been great. Like I said, I feel like I got a free consultation from you. So I appreciate that. I don't know what your hourly rate is, but thanks anyway. Thank you for coming on, brother.
Thank you, man. Yeah, it's going up. It keeps going up because it's been crazy busy. People can get a free 15-minute really intro and consultation if they want to look me up on Instagram, on Twitter, Anthony Price CPA. Look me up on my website. Man, it was really fun. Definitely enjoyed being on the podcast. Thank you for inviting me. Appreciate it. Appreciate talking to everybody and getting to spread my message. So thanks again for having
Absolutely.
me on.
Thank you for plugging yourself. I'll send anybody I know, especially in the entrepreneurial world, your way, man. I could tell just from the conversation I've had with you that you know your shit, man, and I appreciate you sharing it.
Absolutely.
Till next time, you take care.